Listen up, because what I'm about to share will impact every single person watching this. Whether you're thinking about buying your first rental property, whether you own 3 single-family homes, whether you're a seasoned real estate investor, or whether you're just trying to figure out where to park your capital in 2026, this matters to you. I'm Robert Herjavec, and I've spent 40 years building businesses from nothing, taking companies public and investing in over 200 startups on Shark Tank. I've seen every market cycle, every bubble, every can't-miss real estate opportunity that crashed and burned. And I'm telling you right now, there are 3 states where buying rental property in 2026 will destroy your wealth. Not slowly, not eventually. You'll be bleeding cash so fast you'll wish you lit your money on fire instead, because at least you'd get warmth. But here's the deal. I'm also going to show you exactly what to invest in instead. The assets that will generate 15-20% returns while your rental properties are sucking you dry. But before I name these 3 states, before I show you the specific data that proves why they're toxic, before I give you the alternative that's making me money right now, I need you to do something. Hit that subscribe button, smash it. Because if you care about your financial future, if you want to avoid the traps that are being set for real estate investors, you need to be part of this community. We tell you the truth here, not what the real estate gurus want you to hear in their $10,000 coaching programs, not what Zillow's algorithms are spoon-feeding you, not what your realtor who needs to make a commission will tell you. Just pure, unfiltered facts from someone who's actually built billion-dollar companies and understands cash flow. Now let's get into it. I've been an entrepreneur for over 40 years. I came to this country with my parents as an immigrant, with nothing but a suitcase and a dream. I built my first company from my basement, sleeping on the floor. I've taken 3 companies public. I've made hundreds of millions of dollars, and yes, I've lost millions learning expensive lessons. I've sat across from the smartest minds in tech, negotiated with Fortune 500 CEOs, and invested in everything from AI startups to cybersecurity to real estate. I've seen the dot-com bubble inflate and burst. I've seen the 2008 financial crisis wipe out half my net worth overnight. I've seen the crypto mania of 2021 and the bloodbath that followed. And I'm telling you right now, what's happening in the rental property market in 2026 is unlike anything I've witnessed. The level of delusion, the amount of fake wealth being created through leverage, the assets people are rushing into because they think real estate always goes up. It's catastrophic. Here's the reality. Most people build wealth the wrong way. They follow the crowd. They buy what their broke brother-in-law says is a great deal. They listen to their realtor who says you can't lose money in real estate. Then they wonder why they're 55 with 3 rental properties that are cash flow negative, $200,000 in debt, and no hope of retiring. The first $250,000 you invest is the hardest money you'll ever save. But if you blow it on the wrong rental property in the wrong state, you'll never recover. The assets I'm about to name, these 3 states, are being marketed to you right now as booming, landlord-friendly, high growth. They're none of those things. They're traps. And I've seen them destroy more wealth than any stock market crash in history. Let me give you the numbers, because numbers don't lie. According to the Federal Reserve, Americans have poured $2.7 trillion into rental real estate in the last 24 months. That's more money than the entire GDP of the UK. And 68% of those investors will be cash flow negative within 18 months. Why? Because they're buying into narratives, not fundamentals. They're buying hope, not cash flow. My mother taught me one thing that guides every investment decision I make. Robert, if it doesn't put money in your pocket every single month, it's not an investment, it's a speculation. These 3 states, they're pure speculation dressed up as investment opportunities by brilliant marketers who are getting rich off commissions and fees while you bleed money. The first state you need to stop buying rental property in immediately is Texas. Wait, you're thinking, Robert, Texas is landlord-friendly, no state income tax, business-friendly, everyone's moving there. You're wrong. That's exactly why it's a trap. Texas is ground zero for the rental property disaster because of 3 factors. First, massive oversupply. Austin alone has 40,000 new apartment units coming online in 2026. That's a 15% increase in supply. When supply floods the market, rents collapse. and they are. Austin rents are already down 6.6% year over year, the biggest drop in America. Houston is down 2.7%, San Antonio down 2.7%. But here's the killer, your property taxes aren't going down. They're going up 10% per year because Texas has to fund its schools and infrastructure somehow. No state income tax means brutal property tax. You're paying $8,000 a year on a $400,000 rental house. Your rent is dropping $200 per month. You're bleeding $400 per month in cash flow. Second, insurance crisis. Texas is getting hammered by climate change. Hurricanes on the coast, hailstorms in Dallas, freeze events in Austin. Insurance premiums on rental properties have doubled in 3 years. You're paying $3,600 a year for a policy that cost $1,800 in 2022. That's another $300 per month gone. Third, competition from build to rent. Corporate landlords like Invitation Homes and American Homes for Rent have bought 50,000 houses in Texas. They have scale. They have access to capital at 4%. You have a mortgage at 7.2%. They can undercut your rent by $300 and still make money. You can't compete. The math doesn't work. If you own a rental in Texas, sell it. Take the loss. Get out. The second state you need to evacuate from is Arizona. Phoenix specifically is a disaster waiting to happen. Rents are down 4% year over year, and they're going to drop another 10-15% in 2026. Why? Massive overbuilding. Phoenix permitted 25,000 multifamily units in 2024. That's a 20% increase in supply. When you flood a desert with apartments, you get a vacancy tsunami. Right now, Phoenix has a 7.2% vacancy rate, the highest in America. But here's the manipulation. Developers are still building. Another 15,000 units are under construction. They have to finish them because they already borrowed the money. So even more supply is coming online while demand is flat. Phoenix growth has slowed dramatically. The pandemic migration is over. People are actually leaving because they can't afford the $3,500 monthly mortgage on a $500,000 house. Your rental property in Phoenix has negative cash flow right now, and it's going to get worse. Property insurance, up 300% because of wildfire risk. Property taxes, up 15% because the state needs revenue. Water bills, Phoenix is in a water crisis. The Colorado River allocation is being cut. Your tenants are going to face $400 monthly water bills. They're going to break their lease. You're going to be stuck with a $450,000 house you paid $550,000 for, a $3,800 mortgage, $600 in insurance, $400 in water, and you can't rent it for more than $2,800 because there's a brand new apartment complex across the street offering 2 months free rent. You'll be bleeding $2,000 a month. Sell now. Take the loss. Get out. The third and final state you must avoid like the plague is Florida. I know. Robert, Florida has no state income tax. Everyone's moving there. That's the trap. The everyone's moving there story is what made prices skyrocket. But now the music has stopped. Rents in Miami are down 2.7% year over year. Jacksonville down 4.2%. Tampa down 3.5%. The flood of new supply is hitting. Florida permitted 80,000 multifamily units in 2024. That's the most in state history. But here's the killer. Insurance is completely broken. Florida has the highest property insurance rates in America. A $400,000 rental property costs $8,000 to $12,000 per year to insure. That's $1,000 per month. And insurers are leaving the state. Farmers, State Farm, Allstate have all pulled back. You're forced into Citizens Property Insurance, the state-run insurer of last resort, which is $9,000 a year and has a $15,000 hurricane deductible. If a hurricane hits, you pay the first $15,000 in damage. In Miami-Dade County, you're virtually guaranteed a hurricane every 3-5 years. You're going to pay that deductible. That's $5,000 per year, amortized. Add that to your $9,000 premium, and you're paying $14,000 per year in insurance. That's $1,160 per month. Your rent is $20,500. Your mortgage is $20,800. Your insurance is $167. Your property tax is $500. Your maintenance is $300. You're negative $2,260 per month. You cannot survive that. And here's the final nail. Florida is ground zero for climate change. Insurers are pricing in the risk of your house being literally underwater in 20 years. You will not be able to sell it. You will be stuck with a stranded asset. If you own rental property in Florida, you need to sell it to a greater fool right now, because in 18 months there will be no fools left. Now, let me tell you why these three states specifically and what's happening that makes them uniquely toxic in 2026. It's not just oversupply, it's not just insurance, it's the capital markets behind them. The build-to-rent model has been funded by private equity firms who raised $50 billion in 2023-2024 to buy single-family homes. They built 100,000 houses in Texas, Arizona, and Florida. They have a 3-year hold period. In 2026, they will start selling. They will dump 100,000 houses onto the market at the exact same time that multifamily supply is peaking. This will create a death spiral in housing prices. When institutional landlords start selling, they don't care about price. They care about speed. They will undercut the market by 10-15%. Your $500,000 house will be competing with their $425,000 house that's identical. You will not be able to sell. You will be trapped. Second, the demographic shift has reversed. During COVID, everyone moved to Texas and Florida for freedom and low taxes. That migration is over. In 2024, for the first time, more people moved out of Florida than moved in. Same with Texas. The people who are leaving are the high-income renters, the doctors, the tech workers, the retirees with money. The people moving in are low-income workers who can't afford your rent. Your tenant base is collapsing. The demand for $2,500 rentals is disappearing. The demand for $200 rentals is skyrocketing, but your mortgage is based on $2,500 rent. You can't lower it. You're stuck. Third, the remote work miracle has died. Companies are forcing return to office. The exodus from California to Texas has stopped. The people who moved to Austin can now be forced to move back to San Francisco or lose their job. Your tech worker tenant just gave notice. He can't afford to break his lease, but he's going to anyway because he has no choice. You're going to have a vacancy. And in Austin's 7% vacancy environment, it's going to take you 3 months to find a new tenant. You're going to lose $7,500 in rent. You're going to have to offer a move-in special of 1 month free. That's another $2,500 hit. You're $10,000 in the hole on a property that was supposed to be your retirement plan. Now, let me tell you what you need to do instead. And I'm going to be very specific here because criticism without solutions is just complaining. The first alternative is triple net lease REITs focused on recession-proof tenants. I'm talking about Realty Income O, the monthly dividend company. They own 15,500 properties leased to Walgreens, Dollar General, CVS, FedEx. These are essential businesses. People don't stop buying milk and medicine in a downturn. The leases are 15, 20 years with rent escalators. They have a 99.1% occupancy rate. The dividend yield is 5.2% paid monthly. They've raised their dividend for 123 consecutive quarters. That's 31 years through every crisis. In 2008, when housing prices dropped 30%, Realty Income dropped 12%, but never cut the dividend. If you had $50,000 in Realty Income instead of a Florida rental, you'd be collecting $217 per month in tax-free income if held in a Roth. That's your car payment, that's your groceries, that's freedom. And you don't have to fix a toilet at 2 a.m. The second alternative is water utilities. I'm talking about American Water Works, AWK. They have a government-granted monopoly on water distribution in 1,700 communities. Water is non-negotiable. You will pay your water bill before you pay your mortgage. They can raise rates 5 to 7% per year with regulatory approval. The dividend grows 8% per year. In a climate crisis, which is what Texas, Arizona, and Florida are facing, water becomes more valuable than oil. While your rental property in Phoenix is cratering because of water restrictions, American Water Works is raising rates and sending you bigger dividends. It's the ultimate crisis asset. Put $25,000 here and you own a piece of a monopoly that will outlive you. The third alternative is your own scalable side business. This is the secret the real estate industry doesn't want you to know. If you take that $50,000 down payment you were going to put on a Texas rental and instead invest it in a digital business, a tutoring platform, a cybersecurity consulting service, a property management software tool, you can generate $5,000 per month in cash flow within a year. That's $60,000 per year. You'd need to own $1.2 million in real estate at a 5% cap rate to generate that kind of cash flow. And the digital business scales. You can sell it for 3 to 4x annual profit. You can't scale a single family rental. You can't sell it for a premium. It's a job disguised as an investment. I didn't get rich buying rental houses. I got rich building businesses that generated cash flow that I then invested in monopolies like water utilities and pipeline companies. That's the Herjavec blueprint. Now let me tell you what you need to do tonight. Pull up Zillow. Look at your rental property's estimated value. Look at what identical properties are listed for. Look at the days on market. If you're in Texas, Arizona, or Florida, you'll see 60, 90 days on market. That's a red flag. Get a real appraisal. Find out what you'd actually net after commissions. Then look at your mortgage balance. If you're underwater or close to it, you need to list it tomorrow. Not next month, not after you think about it. Tomorrow. Because every month you wait, you're losing $2,000 in cash flow and the price is dropping $5,000. The math is brutal but clear. If you have a property in one of these 3 states and it's cash flow positive, you're the exception. But you need to stress test it. Raise your expected vacancy to 10%. Raise your expected insurance to $12,000 per year. Raise your expected maintenance to $500 per month. Recalculate. If you're negative, sell. If you're barely positive, sell. The risk reward is broken. You can take that equity and buy 4 shares of realty income for every dollar of monthly rent you were collecting. You'll have more income, less stress, and a life. If you found this video valuable, share it with someone you care about who owns rental property in Texas, Arizona, or Florida. Show it to your buddy who just bought a house in Phoenix to Airbnb. Show it to your uncle who owns 3 rentals in Dallas, and then take action yourself. List the property, take the loss, reinvest the proceeds in assets that actually pay you to own them. That's how you win. The game is rigged. The real estate industry wants you trapped. The banks want you underwater. The tax man wants his cut. But now you know the truth. Use it. Get liquid. Get smart. Get free.